guys, today I'll try to explain something very basic for a change. Often you would have heard something called as traditional life insurance policies, and you would have wondered what these traditional life insurance plans are. So I'll try to explain a bit about that and how they actually work. So I'll explain the basic features of a traditional life insurance policy, and that itself would give you a very good idea of what these plans are. So number one, these plans invest your money in very low risk financial instruments. Since they are low risk financial instruments, the returns too are low. So don't go into this plan with expectations of very high returns, even if the person selling you the plan tells you that you will get some phenomenal returns. Generally expect 3 to 6% as an annual return in traditional life insurance plans. In such kind of plans, you cannot decide where your money will get invested or in which kind of instruments your money will get invested. The insurance company decides that and monitors that. You really don't have any option in that. Traditional life insurance plans offers two kinds of maturity benefits. Either a guaranteed maturity amount, so you know what you're walking into, or it offers a bunch of bonuses at various points of time in the policy term. Either way, the type of or the annual return will be more or less the same. Even the bonus rates are not guaranteed and depends on the performance of the company, but you can still get you can be fairly confident that you will end up somewhere between 3 to 6% as returns. Now, some of the flip sides to having such plans. These plans do not offer any flexibility. In case there's an emergency and you want to withdraw some part of the money, it's practically impossible. Or the surrender value is so low that you might as well write off the money that you have actually even paid. In most cases, the surrender value is just 1/3 of the premium amounts that you have paid. So get into such plans only if you're fairly confident that you can pay all the premiums in all the terms comfortably. Also, the amount of insurance cover provided in this plan is not very attractive. Most plans offer a multiplier of 10 to the amount of premiums that you're paying. So if you're paying an annual premium of 50,000 rupees, you might get a cover of 5 lakh. Now 5 lakh is not a sufficient amount of cover for a family. So this can be used as a tax saving instrument or a policy which will give you moderate returns, but this is definitely not your primary insurance coverage plan. For that, always look for a term insurance plan. Also, such plans lack transparency, and when I say that, it means that the money which you are investing, you really don't know into what kind of charges are deducted. You just pay your annual premiums and expect to get a basic return. What charges are going into what heads are not something which are revealed in these kind of plans at all. So here's our pro tip. If you're investing in traditional life insurance plans, ensure that you can comfortably pay the premiums for the rest of your policy term. Otherwise, don't get into it. Get into it only if you're okay with low or moderate returns, as I said, in the range of 3 to 6%. Don't invest in it thinking of saving tax in only that year. No, you might be left with a 75,000 amount to be invested under Section 80CD for that year's tax benefits. But do remember that every year you should have the capability to invest the 75,000. Otherwise, you'll end up with a huge financial loss. So that's it. I hope you got a fair idea of how traditional plans work. If you have any more questions, please do comment and we will be more than happy to help you out and share our thoughts on it. Thank you.